On the question of performance and what is some of the more interesting metrics that one should be have as consideration, I think the worst thing that anybody can do is look at the return performance of any manager or any asset class's performance over X period. Because what tends to happen is the old adage that figures lie and liars figure. And if I'm a manager that has done relatively poorly over the last 6 months, but really well over the last 10 years, guess what I'm going to show you is my performance over the last 10 years. And if I'm the converse of that, a manager that's done very badly over the last 10 years, but had a lucky streak over the last 6 months, I'm going to show you a track record over the last 6 months. So what one should look at, rather than looking at the bottom line or the last number or the performance, and it sort of goes along with another Wall Street adage that more money has been lost reaching for yield than at the point of a gun. So if you're always looking for yield and not understanding how yield is derived, you're setting yourself up for major risk. And one of the things that we do at High Street is attempt to create an asset class that attempts to achieve absolute return, regardless of market conditions, regardless of economic environment, regardless of geopolitical events. And that's what we try to do on a day in and day out basis. And the way that we go about doing this, rather than having an idea that let's buy oil or short oil and look for a lucky trade that may last for 6 months or a year, our returns are basically an extract of literally thousands of trades that take place throughout the day and over a period of time. So good luck, and I hope that your quest for finding the proper asset manager leads us in our direction.
Tell me what absolute return means.
Absolute return is simply a return of your investment without any kind of benchmark. If your benchmark is the S&P 500 and you're compared to the S&P 500 and you get paid by your outperformance to the S&P 500, well, that sounds good until you run into a scenario that's taken place over the last 2 or 3 months, which I'm sure that everybody that's sitting here watching this understands and has realized the S&P 500 is down 30 or 40% for the last 2 or 3 months. So if I was paid by outperforming the S&P 500 and I'm down 28% and the S&P is down 40%, well, you owe me money. You owe me money, but you lost 28%. Not a good